This is day 37 of the investment series. It's been a while again, and I'm sorry for that, but I was a little sick last week, and so I couldn't get on this as I should have. But we'll try again to stay consistent, and this time I hope for long till we finish this book, obviously. And so we'll start with continue with bills and inflation from 1926 to 2015, which is 5.3. One sec. Financial Time series, business inflation 1926 to 2015. Financial Time series often begin in July 1926. The starting date of a widely used return database from the Center for Research and Security Prices at the University of Chicago. Table 5.2 summarizes the history of returns on 1 month US Treasury bills, the inflation rate, and the resultant real rate. You can find the entire post 1926 history of the monthly rates of the series in Connect, a link to material for chapter 5. The first set of columns of table 5.2 lists average annual rates for 3 periods. The average interest rate over the more recent portion of our history, 1952 to 2015, essentially the post-war period, 4.45% was noticeably higher than in the earlier portion, 1.04%. The reason is inflation, the main driver of T-bill rates, which is, wait one sec, table 5.2, statistics for T-bill rates, inflation rates, and real rates, 926 2015. So average annual rates. So all these are the different rates that are given. These are the equations that we'll have to remember, sort of. I'm not gonna memorize them because this is not my course. I'm just doing this for as a side thing, obviously. So I'll just refer to them when solving questions, and when I'm eventually giving my CFA in a few months. I haven't registered for it yet, but I will, and I'll prep for the CFA over the summer after this sem finishes. And yeah, when I'm doing obviously that, then I'll memorize the formulas, but not right now. Anyways, which also had a noticeably higher average value, 3.53%, in the later portion of the sample than in the earlier period, 1.68%. Nevertheless, the nominal interest rates in the recent period were still high enough to leave a higher average real rate, 0.90%, compared with a negative 29 basis points, minus 0.29% for the earlier period. Figure 5.2 shows why we divide the sample period at 1952. After that year, inflation is far less volatile, and probably as a result, the nominal interest rate tracks the inflation rate with far greater precision, resulting in a far more stable real interest rate. This shows up as a dramatic reduction in the standard deviation of the real rate documented in the last column of table 5.2. Whereas the standard deviation is 6.27 in the early part of the sample, it's only 2.13% in the later portions. The lower standard deviation of the real rate in post-1952 period reflects a similar decline in the standard deviation of the inflation rate. We conclude that the Fisher relation appears to work far better when inflation itself is more predictable and investors can more accurately gauge the nominal interest rate they require to provide an acceptable real rate of return. Okay, next part is 5.4, risk and risk premiums, holding period returns. You are considering investing in a stock index fund. The fund currently sells for $100 per share. With an investment horizon of 1 year, the realized rate of return on your investment will depend on A, the price per share at year's end, and B, cash dividends you will collect over the year. Suppose the price per share at the year's end is $110, so it's increased $10. Cash dividends over the year amount to $4. So the realized return, called the holding period return or HPR, in this case the holding period is 1 year, is defined as HPR equals to ending price of share minus beginning price plus cash dividend divided by beginning price. So in this case, it'll be 110 minus $100 plus $4 divided by $100, or 14% as the holding period return. The definition of the HPR treats the dividend as paid at the end of the holding period. When dividends are received earlier, the HPR should account for reinvestment income between the receipt of the payment and the end of the holding period. The percent return from the dividends is called the dividend yield. And so dividend yield plus the rate of capital gains equals HPR. Expected return and standard deviation. So this I'm doing in my econometrics also. So there is considerable uncertainty. So this is where my courses and this sort of merges. And these are basically financial from what I understand. These are the financial applications of the concepts I'm learning. So I've always hoped, for years now at this point, that I be consistent in this as well as my courses, and everything just syncs up so that I can see what's happening and how these concepts are applied to real life use, so that I find them more appealing to study and to practice. Otherwise, it's all theory for me, so it gets kind of confusing and boring. Anyways, let's just keep doing it. So yeah, there's considerable uncertainty about the price of a share plus dividend income 1 year from now. However, so you cannot be sure about your eventual HPR. We can quantify our beliefs about the state of the market and stock index fund in terms of 4 possible scenarios with probabilities as presented in columns A through E of spreadsheet 5.1. How can we evaluate this probability distribution? To start, we will characterize probability distributions of rates of return by their expected or mean return, ER, and the standard deviation, sigma. The expected rate of return is a probability weighted average of the rates of return in each scenario, calling P as the probability of each scenario and R as the HPR in each scenario, where scenarios are labeled or indexed by S. We write the expected return as ER equals to sigma SPS into RS. So PS is the probability of each scenario and RS is the holding period return in each scenario. So applying this formula to the data in spreadsheet 5.1, the expected rate of return on the index fund is this. So this is where the data is from. So they're telling us state of the market, excellent, good, poor, crash. So then probabilities are distributed like this. So probability of a good market is the most at 0.45%, followed by the two excellent or poor, and then crash is the lowest at 5%. So based on that, the year-end price is calculated somehow, and like it is assumed, like given, it's random, and then cash dividends are also given according to the state of the market. And then so based on that, so we multiply this and this, and then we get our HPR, and then we multiply this this and this, and so on and so forth, we get our HPR. Or maybe we get our HPR. 1 second. HPR was okay, so 26.5, so that'll be 27, so that'll be 31, so that'll be 31. Oh yeah, so that'll be 31%. So we just applied the formula that we learned here over here. So we got the HPR's column based on these two things. We got this and probabilities are given, assumed, whatever, and then deviations from mean. So the mean is equal to okay, so we just add all of these up and divide them by 5. So the mean is coming as 0.0976. So deviations from the mean, so we'll just do deviations from the mean, so we'll just do x minus this. So let's just try that for just one, just to see if the numbers match out. So that's 0.31 minus 0.0976, 0.2124. Yep, as we can see, it says 0.2124 right there, so that clicks out. that checks out, sorry. Squared deviation, so we just square that, we get that. Excess returns, so excess returns, I don't know what that means. Excess returns, does that mean, oh yeah, one second, excess returns, I don't know how they found excess returns, but anyways, squared deviations from the mean. Okay, sure. Anyways, all these are the values that we calculated. Pretty good stuff. I'm understanding this pretty clearly now. That was, I think, a little confusing. It definitely was confusing, but that's okay. You know, we can handle. And what the hell? Yeah. And yeah, okay. Spreadsheet 5.1 shows that this sum can be evaluated easily in Excel using the sum product function, which first calculates the products of the series of numbered pairs, then sums the products. Here the number pair is the probability of each scenario and the rate of return. Okay, the variance of the rate of return, sigma square, is the measure of volatility. It measures the dispersion of possible outcomes around the expected value. Volatility is reflected in deviations of actual returns from the mean. Return. In order to prevent positive deviations from cancelling out with negative deviations, we calculate the expected value of the squared deviations from the expected returns. The higher the dispersion of outcome, the higher will be the average value of the squared deviations. Therefore, variance is a natural measure of uncertainty. Symbolically, sigma square equals to summation PS into RS, which is the rate, minus expected value squared. So this is the square of deviations from the mean return times the probability and the whole sum, on and on and on. That's the variance. So therefore, in our example, variance is equal to 0.0380. This value is calculated in cell G13 or spreadsheet 5.1 using the sum product function. When we calculate variance, we square deviation from the mean, therefore change units. To get back to original units, we calculate the standard deviation as the square root of variance. Standard deviation calculated cell G14 is sigma equals to 19.49%. Clearly, what would trouble potential investors in the index fund is a downside risk of a crash or poor market, not the upside potential of a good or excellent market. The standard deviation of the rate of return does not distinguish between good or bad surprises. Treats both simply as deviations. Oh, that's true, from the mean. Still, as long as the probability distribution is more or less symmetric about the mean, sigma is a reasonable measure of risk. In the special case where we can assume that the probability distribution is normal, represented by the well-known bell-shaped curve, so ER, expected return, and sigma completely characterize the distributions. Excess returns and risk premiums. How much, if anything, would you invest in the index fund? Okay, first you must ask how much of an expected reward is offered for the risk involved in investing in stocks. We measure the reward as the difference between the expected HPR on the index stock fund and the risk-free rate. That's the rate at which you would earn in a risk-free asset such as T-bills, money market funds, or the bank. We call this difference the risk premium on common stocks. The risk-free rate in our example is 4% per year. The expected index fund return is 9.76%. So the risk premium on stocks is 5.76 per year. The difference in any particular period between the actual rate of return on a risky asset and the actual risk-free rate is called the excess return. One sec, I'll read this again. Okay, the difference between the expected HPR on index stock fund and risk-free rate is called the risk premium on common stocks. Risk-free rate in our example is 4% per year. The expected index fund return is 9.76%. So the risk premium is 5.76% per year. So the risk premium is basically the excess return that you're getting from taking that risk of investing in assets such as stocks, which are obviously more risky than investing in a guaranteed bank where you're getting a risk-free rate of 4%. That is essentially the idea. The difference in any particular period is called the excess return. Okay, got it, got it. Okay, that's how they calculated this column. That's why I was not understanding. Okay, got it. Yeah, so see, 31 minus 4 is 27. That's how they got this. Yeah. Okay, cool. Yeah, so, yeah. Excess return, standard deviation of excess return measure. So, 5.1 for the acceleration. Notice that the risk premium on risky assets is a real quantity. The expected rate on a risky asset equals the risk-free rate plus a risk premium. That risk premium is incremental to the risk-free rate and therefore makes for the same addition whether we state the risk-free rate in real or nominal terms. The degree to which investors are willing to commit funds to stock depends on their risk aversion. Investors are risk averse in the sense that if a risk premium were zero, they would not invest any money uh, in stocks. In theory, there must always be positive risk premium on stocks in order to induce risk averse investors to hold existing supply of stocks instead of placing all their money in risk free assets. One sec. Just look up what risk averse means. Forgotten. Okay, so basically somebody who's not want to take too much risk, who wants to play it safe. One second. Yeah. So where are we? Yeah. Okay. So risk averse is somebody who doesn't want to take too many risks, basically. So how do you induce somebody like that? By putting a positive risk premium. As a general rule, uh, when evaluating the risk premium, the maturity of the risk free rate should match the investment horizon. Investors with long maturities will view the rate on long term safe bonds as providing the benchmark risk free rate. To properly consider a long term investment, therefore, we should begin with the relevant real risk free rate. In practice, however, excess returns are usually started relative to 1 month T bill rates. This is because most discussions refer to short term investments. Concept check 5.3. You invest $27,000 in a corporate bond selling for 900 per $1,000 par value. Over the coming year, the bond will pay. One second. Okay. Yeah. So over the coming year, the bond will pay interest of $75 per $1,000 of par value. The price of the bond at the end of the year will depend on the level of interest rates prevailing at that time. You construct the following scenario analysis. Interest rates higher, unchanged, lower. Probability distribution is 0.2, 0.5, 0.3. Year-end bond price is 850, 915, 985. So if there's lower interest rate, so what happens? Lower interest rate. Lower interest rate means that people lower interest rate lower interest rate. Okay, higher interest rate, people putting money in the bank. People putting money in the bank. People putting money in the bank. A lot of people putting money in the bank. Wait one second. I need to search this as well. Okay, so because new bonds get more attractive when rates rise. Okay, okay. So old bonds have to drop in price to compete. Okay, okay, okay. Because everybody wants to put it. Hey, that doesn't make any sense. And if there was more demand, wouldn't the price increase? Uh, hmm. Okay. Higher coupon, more attractive, lower fixed coupon. Um. Uh. Oh, okay, okay. Oh, so okay. If the rates increase, other new bonds will have higher expected payoffs, and therefore nobody would want my percent bond will have 8%. If the rates fall, every money would under 5% because would increase. When you sell something, you buy it back. Oh, no, it's not like so. Okay, basically, if interest rates increase, new bonds are issued at higher coupons, like 8%. Your bond is stuck at 5%. So my bond is less attractive. Never price falls. If interest rates decrease, new bonds are issued at lower coupons, like 3%. And my bond still pays 5%. Now my bond is more attractive. Its price rises. Perfect, perfect. Got it. Got it. Okay. Perfect. Yeah. Anyways, yeah. So, this is a question we have to do. Okay. Your alternative investment is a T-bill that yields a sure rate of 5%. 5% rate of return. Calculate the HPR for each scenario, the expected rate of return, and the risk premium on your investment. What is the expected end of your dollar value of your investment? HPR for each scenario, expected rate of return, and the risk premium of your investment. Okay, so the risk free rate is equal to 5%. And now I have to find, okay, yeah, okay. Okay. Calculate the HPR. Okay, so in the first one, this is probability distribution. You have to multiply it by the things. 1 second. HPR equals to that. Okay, so we can just add the HPR column right here. We can do this. HPR. Okay, so we are putting 900. Just say 900. Oh, we also get that $75. So we get 75. We get 75. Okay, bond will pay in interest. Okay, 75. So it's 1,000. So that's 900. So it's 30. 75 times 30. 2250. 2250. Okay, 2250. Actually, we just use the 75. Actually, better for calculation. 75. 900. Year-end bond price fell 50, but then we got 75. So 25. So 25 is the gain divided by the 900 times 100. It's 2.7%. So let's do, yeah, 0. 1 sec. By the way, we have to end with this one because I have to go for lunch. Oh, shit, my bad. Should not have erased that. Yeah. Okay, so this is 0.027. Okay. And then this one is 15. So this one is 90. So this one is 10, right? That was 0.1. And then this one is 85. So this one is 85 plus 75 by 900. This one's 0.178 basically. Okay, that's the HPR. What else are we supposed to find? Each scenario. So if, HPR for this one is yeah, it's 5% only. There's no, you're not getting anything else. That's HPR 1. I mean, I'm pretty sure you're not getting any dividends, you're not getting nothing. So yeah, HPR is 5% only. Holding period return, yeah. HPR 1, HPR 2. Okay. HPR for each scenario done. Expected rate of return. How do you find that? How do you find the ER? Okay, ER equals to the 0.25 times, okay, like that, okay. So expected rate of return will be, okay, like that, okay. So expected rate of return equals to, इसमें expected rate of return will be 5% only, without fail. Expected rate of return okay, for 1, so that's 0.2 times, okay, so now we do some nice calculations. 0.2 times 0.027. 027. It's 0.005. Actually write it 0.0054 plus 0.2 times 0.5 times 0.1, 0.05 plus 0.3 times 0.178. 0.0534, which will be equal to this plus 0.05 plus 0.0054, 0.1088, 1088. Okay, expected return is 10.88%. Okay, that's done. Risk premium. So risk premium is 10.88 minus 5.88. So the risk premium, what is the symbol for risk premium? I think we used theta. So we'll just use theta again. 5.88%. Okay, what is the expected end of year dollar value? How do we calculate that? Okay, end of your dollar value. Okay, got it. So end of your dollar value. So that would be 1.1088 times 27 grand. That'd be 29937.6. Okay, let's write it here. 29937.6 dollars. The end. Let's see if we are correct, and then end the session. Good session, amazing session, honestly. It's one of the best sessions I've ever had, honestly. Okay, 5.3, right? Yeah. Okay, we have everything here. So the okay, yeah. Okay, what the hell? Yeah. Okay. Yeah. 0.0278. Yeah, same thing. Go. Where did it go? Yeah. Okay. 0.1. So this is correct. 0.1.178 correct. Expected rate of return ER equals to 10.89%. This is also correct. I should not do anything here. Okay, and then expected end of year dollar value 29940. I'm just a little bit off. 29937.6. I don't know how that happened. Oh, you have to do probability distribution like that. Okay. I just did it. Expected rate of return. Okay, got it. So the individual HPRs according to the different probability categories, you have to do the summation then at the end, and then just add it all up. And the risk premium is 5.89%, 5.88%, correct. Anything else? Yeah, it's done. All correct. I'm so happy. Anyways, although the scenario analysis in spreadsheet 5.1 illustrates the concepts behind the quantification of risk and return, you may still wonder how to get a more realistic estimate of ER and sigma for common stocks and other types of securities. Here, history has insights to offer. Analysis of historical record of portfolio returns make use of a variety of statistical concepts and tools. So we first turn to a preparatory discussion. So we'll do that at night, 100%, at around 9:30. So that'll be fun. And yeah, that was an amazing session, and I can't wait to do it again. Anyways, thanks.